Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, what is the best advice for a fresher to start investing in stocks? Answer by Diversify. Hello everyone. Plenty of people know that there are great potential profits to made in the stock market, but investing in stocks is not a project to leap into blindly. Pick source Google. The following information covers some important tips for you to consider while thinking about buying stocks and putting your money at risk. If you would like to make maximum amount of money from investing in the stock market, try to create a long-term plan. You can find true success the more reasonable you are. This way to know what to expect and aren't surprised. Once you have a target for your profits, hang on to the stocks you buy until you reach them. Buying stock is easy. The challenging part is choosing companies that consistently beat the market. That's something most people can't do, which is why investing in a diversified mix of low-cost index funds and exchange-traded funds is a smart long-term strategy for the average investor. Pick source Google. Here's some investing habits essential for success in the stock market. Check your emotions at the door. Pick companies, not ticker symbols. Plan ahead for panicky times. Build up your positions with a minimum of risk. Avoid trading overactivity. Take advantage of compounding. Know why interest rates are your friend. Don't base investments on fear of political uncertainty. Do not fall in love with your investments. Control your greed. Actually be diversified. Remember, buying a share of a company's stock makes you a part owner of that business. Time, not timing, is an investor's superpower. Nerd tip. Returns are only one part of the investing equation. Fees can easily erode much of what you earn if you are not careful. Everyone is looking for a quick and easy way to riches and happiness. It seems to be human nature to constantly search for a hidden key or some esoteric bit of knowledge that suddenly lead to end of the rainbow or winning lottery ticket. Set long-term goals. Why you are considering investing in the stock market? Will you need your cash back in 6 months, a year, 5 years or longer? Are you saving for retirement, for future college expenses, to purchase a home, or to build an estate to leave to your beneficiaries? Before investing, you should know your purpose and the likely time in the future you may have need of the funds. If you are likely to need your investment returned within a few years, consider another investments. The stock market, with its volatility, provides no certainty that all of your capital will be available when you need it. Remember that growth of your portfolio depends upon 3 interdependent factors. The capital you invest, the amount of net annual earnings on your capital, the number of years or period of your investment. Ideally, you should start saving as soon as possible, save as much as you can, and receive the highest return possible consistent with your risk philosophy. Handle basics first. Before making your first investment, take the time to learn basics about the stock market and the individual securities composing the market. It is not a stock market, but a market of stocks. Financial metrics and definitions. Understand the definitions of metrics such as the PE ratio, earnings per share, EPS, return on equity, ROE, and compound annual growth rate, CAGR. Knowing how they are calculated and having the ability to compare different companies using their metrics and others is critical. Popular methods of stock selection and timing. You should understand how fundamental and technical analysis are performed, how they differ, and where each is best suited in a stock market strategy. Stock market order types. Know the differences between market orders, limit orders, stop market orders, stop limit orders, trailing stop loss orders, and other types commonly used by investors. Different types of investment accounts. While cash accounts are the most common, margin accounts are required by regulations for certain kinds of trades. You should understand how margin is calculated and the difference between initial and maintenance margin requirements. As Warren Buffett said, risk comes from not knowing what you are doing. Some hints here before investing in stocks. Try not to invest your savings. Keep up investments discipline. Oversee risk and money wisely. Hold diversified portfolio. Keep a long-term goal. Keep in mind a stock is a company. So, before investing, learn more about stock market. If needed, take professional help before investing in stocks. Here's zero to discount brokerage, offering zero brokerage on investments or delivery, and we can learn from basics about stock market for free. By Varsity Tool. Open an online trading and demat account with Zeroda and enjoy the lowest brokerage. Happy investing. Regards. Drizziness. Answer by Bertie Iveshak. I have the following advice for freshers who want to become successful investors. Read a lot. Read business newspapers, magazines, annual reports, books. This is how you build knowledge. Read the essays of Warren Buffett to know the thought process of Buffett. Read One Up on Wall Street to know how Peter Lynch uses the sheer power of observation to select unknown stocks. Read books on human psychology like Seeking Wisdom to improve your decision-making skills. Read this PDF, http://www.valueplays.net/WPCon. To learn from great minds like Charlie Munger, read Extraordinary Popular Delusions and the Madness of Crowds to understand the history of market bubbles. Read The Thought Process of Professor Sanjay Bakshi from his blog. Just read as much about successful investors as you can. Learn from mistakes. Before you invest in a stock, make detailed notes about why you're investing in it and why are you not investing in any other stock that you know. If things turn out to be different from your expectations, refer to your original analysis and try to find out what did you miss. Write down your specific mistakes and read them every time before investing in, or rejecting, a new stock. Learn to accept your stupidity. Wise people tell us to learn not only from our own mistakes but also vicariously from the mistakes others make. This applies in life as well. Learn from the failure of companies. Why do some companies go bankrupt while others flourish? What were the key factors responsible for failure? Make a list and remember those factors. Become extremely focused. Instead of finding hundreds of companies per year, make a name of selecting just 23 companies worth investing in a year. You will still scan hundreds of companies per year, but selecting just 23 companies out of them will push you to dig deeper, find out hidden risks and advantages. Your aim should be to find opportunities with minimum risks and maximum rewards. You will buy only when business conditions and valuations are in your favor. Your results will start improving. Answer by Mo Nusoni. You will find many investors entering the market at high levels and making a quick exit as the market witnesses a correction. Unfortunately, such investors seldom think of investing in stocks again. Thus, they ignore an excellent opportunity to earn above-average returns. In short, investing in equities can be a difficult proposition for retail investors. However, equity must form a part of every investor's portfolio. The proportion could vary, depending on the investor's age, monetary requirements, risk appetite, etc. To cope with volatility, it is important to have a disciplined and systematic approach to equity investment. Set your own rules and, more importantly, follow them religiously. Indeed, the mantra for successful equity investment is a well-thought-out, disciplined investment strategy. A long-term monetary commitment, adherence to discipline in investment and decisions based on company fundamentals are essential ingredients for successful equity investment. Here are golden rules for safe equity investment, which could help you to sail through different market scenarios. 1. Be a long-term investor. This is the first and most important rule of equity investment. Timing the market, entering the market at low levels and exiting at higher levels, is almost impossible. Though often heard on the street, this strategy is difficult to implement, as it is nearly impossible to gauge when the market has peaked and when it has bottomed out. Do not play the guessing game. It is more sensible to put money into the market with a long-term commitment. Trading or speculating seldom helps in equities. You could make quick bucks by trading in 10 deals, but you could lose whatever you have earned in just one deal. This is the risk you take when you try to trade and make easy money from the stock market. Apart from incurring financial losses, it also involves a lot of mental stress. Trading could give you sleepless nights. Globally, economies follow 7-year business cycles of boom and bust. Thus, when you are investing, invest for a fairly long term, say 3 to 7 years. Indeed, it is a proven fact that over the long haul, equities tend to outperform all other asset classes. 2. Invest time and efforts in doing your homework. Investing in equities is not a one-time affair. You need to invest a lot of time and efforts, apart from money, to understand industries, economic trends and so on. Further, you should dedicate time to analyze companies, as this will help you to avoid costly mistakes. You need to develop the habit of reading first-hand information, such as company annual reports, company announcements and so on. Annual reports of large companies are easily available on the web. Reading business dailies is also a must for equity investors. Get your basic concepts and fundamentals right. Revisiting financial fundamentals periodically would be a good idea. You need to understand basic concepts like the price-earning ratio, PE ratio, operating margins, earnings per share, etc. Analyzing balance sheets and profit and loss accounts is a must. A short-term course on ratio analysis would be of immense help. Further, understand technicalities of investment, like how the stock market operates, how to buy or sell, settlement procedures, etc. Also focus on domestic economic and policy development. These factors are also of immense importance as they lead to structural changes in the economy that would benefit certain industries. For instance, the boom in the telecom sector in the domestic market is driven by government policy initiatives over the years. Lastly, you also need to keep yourself abreast with key global developments. With liberalization and subsequent integration of economies, global factors also impact domestic industries in the stock market. The stock market is said to be all about sentiments. However, in this mad rush you need to stay focused and maintain a lot of discipline in executing your investment strategy. Thus, irrespective of which way the market moves, you need to stick to your investment strategy without getting swayed by market sentiments. In short, discipline in your investment approach will protect you from the herd mentality. Most investors are tempted to buy when everyone is on a buying binge and sell when the market is moving southwards. But if you have decided as a rule to buy a particular stock only when the overall market corrects by 1%, this rule could kill your temptation to jump on the stock when the market is overheated. 3. Pay the right price. It is essential to buy at the right price, that is, the price that you are comfortable paying. Do not buy because others are doing so. This will help you to hold the stock for a longer duration. Conversely, when you have to decide when to sell, if you feel that the market is overheated and prices have reached unrealistic levels, exit. Don't stick on hoping for a little more. It helps to limit your own greed. 4. Portfolio diversification. Diversion is a very old and popular investment strategy, applied to reduce portfolio risk. Actually, before you start investing in equities, you should consider various factors like your age, monetary requirements, etc., to determine how much risk you can take on. For instance, if you are around 30 years old, you can invest a greater portion of your portfolio in equities than a retired person. Once you have determined how much risk you can take on and how much you can invest regularly in equities, try to achieve diversification in your portfolio. To reduce risk, diversify within equities by investing across sectors. Do not invest in one or two sectors, or any negative development pertaining to those sectors could severely impact the profitability of your portfolio. Secondly, ensure a good blend of small, mid and large cap stocks in your portfolio. While large cap stocks would lend stability to your portfolio, small and mid cap stocks would give you an above average appreciation. Basically, growth potentials are higher in the case of small and mid cap stocks. Thus, just having large cap stocks could be safe but also mean that returns are just about at the same level as market returns. Thirdly, invest across value and growth stocks. Growth stocks are risky but also offer higher returns, while value stocks are likely to be less volatile. In brief, when you spread your investments over a larger number of stocks and sectors, if a few stocks/sectors underperform, this is compensated by other stocks/sectors which perform well. 5. Do not buy on tips or rumors, rather focus on fundamentals. Tips and rumors are an integral part of the stock market. Always remember that these could be engineered by a group of traders or punters. Therefore, a sharp rally based on rumors could fizzle out in a short time. You should strictly stay away from rumors, suggestions or tips received from your broker or friends or the investor circle. Investments based on tips could lead to huge losses. Rather, you would be better off investing based on industry and company fundamentals. Furthermore, generally such tips pertain to small and mid-cap stocks, where liquidity is extremely limited. If you invest in such stocks, you could get trapped in an illiquid investment for a very long time. 6. Buy shares of companies whose business you understand. In the long run, the stock market rewards companies with strong fundamentals and good financial performance. Therefore, it is essential for you to invest in companies whose industry dynamics and business models you understand. This will help you to gauge whether a transformation in an industry is positive or negative, at an early stage itself, and its likely impact on the company's fundamentals. Your understanding of industry dynamics would help you to evaluate industry trends. 7. Don't sell in panic. Markets go through cycles of boom and bust, and volatility is a way of life in equities. Do not sell your holdings in a hurry and panic just because your stocks have witnessed a sudden correction. Always focus on company fundamentals. If they are intact, there's nothing to worry about. 8. Do not borrow money to invest in equities. It is true that equities tend to outperform other investment avenues in the long run. However, there is no guarantee that you will make money on your stocks, either in terms of dividends or capital gains, if your sale of shares is time-bound. Therefore, if you borrow funds to invest in equities, it might be difficult for you to repay the interest or principal on the loan on time. What really matters in equity investment is your withholding power. So, invest your surplus money in equities and only invest an amount that you will not need in the immediate future. If you borrow and invest, your withholding power to stay invested for the long term could be limited. 9. Do not marry a stock. If you feel your investment decision has gone wrong, exit the counter. Don't try to average. It is prudent to cut losses, rather than lower the average purchase price. Particularly in cases where the stock is witnessing a continuous sell-off, it is better to offload your position and book losses. You can use the same money to invest in other opportunities. 10. Invest regularly and gradually build up your position. Just as you put money into fixed interest-bearing investments regularly, also invest in equities on a periodic basis. Further, do not invest at one go. Rather, buy on a regular basis and in small lots. This will help you to buy stocks at a reasonable price. 11. Monitor your portfolio. Investing in equity is not a one-time affair. Buying shares is perhaps the smallest part of the overall investment activity. It is important to periodically monitor and review your investment portfolio. It is always prudent to sell a stock if you feel that the fundamentals have deteriorated and the stock is overpriced in comparison to its fair value. Money has an opportunity cost, and by selling an overvalued stock you can investment the same money elsewhere, for better capital appreciation opportunities. Follow my regular stock market picks, Facebook or Twitter.